Okay, so we are going to be doing some more transactions, but we're going to be adding some new accounts for us to use, and that's going to be sales accounts and some expense accounts. So we've already talked about revenue and how it increases owner's equity and how expenses and withdrawals decrease owner's equity. So in order to avoid a capital account with a ton of different entries in it, we are going to create some more accounts that kind of go within the capital account. They kind of go under the capital account T account here. So the first one we're going to create is a sales account. So a sales account is a type of capital account, but it is a revenue account. And in this case here, on August 12th, we received cash from sales, $295. So the way we would do that one is if you received cash, then your cash is increasing. So cash is an asset. Assets increase on the debit side, so we would plus $295. Sales has a normal balance on the credit side. Sales is increasing in this case as well, so we would put the $295 on the credit side of sales. Here's another one. If we sell services on account, in this case, we're selling services on account to Oakdale Schools for $350. In that case, our accounts receivable Oakdale Schools account, which is an asset, that will increase on the normal balance side, which is the debit side. And our sales account will increase on its normal balance side, which is the credit side. Okay, expenses decrease owner's equity. So again, to avoid our capital account having a ton of different entries in it, we're going to create some expense accounts. So we can have like advertising expense, and we can have rent expense, we can have miscellaneous expense. We can have a number of different expense accounts. Expense accounts have a normal balance on the debit side. Okay, so expense accounts have a normal balance on the debit side. And the reason is because it's kind of a T account under the owner's equity T account. So this is kind of the reason why that happens. So any expense account is going to have a normal balance on the debit side. So for instance, if we paid cash for rent, our cash would be decreasing and our rent expense would be increasing. So this is how that would work. So cash, since it's decreasing, it's going to go on the credit side. And then rent expense, since it's increasing, is going to go on the debit side because expense accounts have a normal balance on the debit side. August 18th, received cash on account from Oakdale Schools. Okay, so if we're receiving cash on account from Oakdale Schools, so cash is increasing. So we're going to put that on the normal balance of our cash T account, which is the debit side. And the amount that Oakdale Schools owes us is decreasing. So that's going to go on the credit side for Oakdale Schools, the accounts receivable Oakdale Schools account. Withdrawals also decrease the owner's equity, and we are going to create an account for strictly withdrawals. It's called a drawing account. So it will be, in this case, we have Kim Park. It'll be called a park drawing account. So if we pay cash to owner for personal use, $125, we will have cash decreasing $125, so it'll go on the credit side. And then drawing accounts, like expense accounts, have a normal balance on the debit side. So we will have a debit of $125 on the park drawing account. Okay, you need to watch the second video so that way we can do our work together.